All right, let's talk about Strike Finance. It's a decentralized derivatives platform on Cardano. And honestly, it's set up like a high stakes game. Today, we're going to break down how it all works by looking at the two main sides of the coin, the daring trader versus the calculating house. So let's just dive right in. So first, let's get our heads around this core idea. I want you to forget about buying crypto, holding it, and all that. Strike uses what's called a synthetic model. And what that means is when you open a position, no assets are actually bought or sold on the open market. Nope. It's just a pure, direct bet on which way you think the price is going to go. In this digital arena, you've basically got two main players. On one side, there's the trader. They're risking their own money, their collateral, for a shot at some pretty big returns. And on the other side, you've got the liquidity provider, or LP. Just think of them as the house. They're the ones funding the trader's bet and taking the opposite side of that bet. It's a total zero-sum game, and you really got to understand this dynamic to get how the whole thing works. Okay, so let's start by walking in the shoes of a trader on Strike. This is where all the action and all the risk really kicks off.
You know, the biggest draw for any trader is, of course, leverage. On Strike, you can put down a pretty small amount of collateral, let's say 100 ADA, but use it to open a position that's actually worth 1,000 ADA. You're basically borrowing the other 900 ADA from those liquidity providers to make your bet that much bigger.
And when a bet like that pays off, man, the results can be huge. There's this one example in the docs where a trader put up $500 in collateral, the price moved their way, and they walked away with a $400 profit. That's on top of getting their initial stake back. I mean, that's the kind of potential that gets traders excited. Of course, with that kind of reward comes some serious risk. Leverage, as you know, is a massive double-edged sword. So what happens when the market decides to move against the trader? Okay, let's look at the numbers here, because this is where it gets real. So a trader starts with $275 in collateral. The market turns against them, and suddenly they have an unrealized loss of over $145. That loss gets subtracted directly from their collateral, leaving them with just under $130. But here's the killer metric, the margin ratio. Their remaining collateral is now only 4.67% of their total position, and that has just dropped below the 5% minimum you have to maintain. And the second that threshold gets crossed, this is what happens. Bam. The system automatically and instantly closes the position. It's over. And the platform is brutally honest about what this means. As the quote says, you don't get anything back. Your entire initial collateral is forfeited. So in that example we just saw, the trader loses their full $275. Gone. A total wipeout. So this begs a really important question. If the trader's collateral is just forfeited, where does it go? Well, this brings us to the other side of the bet, our second main character, the house. Liquidity providers, or LPs, are really the engine of the whole platform. They pull their assets together, and that big pool of money is what's used to fund the leveraged trades. So, in a way, for every trader who's betting the price will go up, the LPs are effectively taking the other side of that bet, and vice versa. They're the counterparty to every single trade.
So how does the house actually make its money? Well, it's got a few ways. LPs get 100% of all forfeited collateral from liquidations. They get 100% of the losses from traders who close their positions in the red. They get 100% of the hourly fees traders pay to borrow funds. And on top of all that, they get a slice of the fees for just opening a position. You can see their profit is tied directly to what traders are doing.
And here is the fundamental, kind of cold, hard truth that makes being an LP a viable long-term strategy. The platform's own materials point out that, historically speaking, most leveraged traders lose money over time. Yeah, there can be moments or even weeks where traders as a group are profitable, but the long-term odds, they tend to favor the house. Okay, so we have our trader and we have our house. Now let's look at the actual rules of the game, the core mechanics that are built in to keep the whole system balanced and manage risk for everybody involved. This is actually pretty clever. To stop the system from getting way too lopsided, like imagine if 95% of traders were all betting the price of Bitcoin would go up, the platform uses dynamic fees. If too many people are piling into the same trade, the cost to open that trade goes up automatically.
And that makes the opposite, less popular trade a little more attractive. It's a built-in, self-balancing mechanism.
Now, this right here is a really important feature on Strike, and it's a huge deal for traders. We've talked about how final and brutal liquidation is, but Strike has this unique safety net called rebalancing. So instead of your position just getting slammed shut, the system can automatically lower your leverage. It basically pays back some of the money you borrowed, which keeps your position open and helps you avoid that total loss.
And this explains exactly why it matters so much. I mean, let's be real, crypto markets are wild. You get these sudden, crazy price spikes and drops that can cause unfair liquidations. Rebalancing is designed to help you survive those sudden storms. It gives you a fighting chance for the market to recover, letting you maybe get back some of your losses instead of just losing everything in a flash. It's a really crucial protection. So up to this point, we've seen two ways to play this game. You can be the trader or you can be the house. But there's actually a third option. You can own a piece of the casino itself. Let's see how that works. This all happens through the platform's own token, Strike. And holding it isn't just about hoping the price goes up. It's deeply, deeply woven into the platform. You can use it for collateral, you get discounts on your trading fees, you can vote on where the protocol goes next, and maybe most importantly, you can stake it to earn a piece of the revenue the whole platform makes.
And when you look at how the tokens were distributed, it kind of tells a story. A massive 60% was set aside for the public sale, another 13% for the DAO, that's the community treasury, and 12% for liquidity. It really shows a focus on getting the token into the hands of the people actually using the platform.
The staking part is super straightforward. You stake your STRI tokens, and in return, you get a share of the revenue that comes from all the position opening fees. So it directly ties the token holder's success to the platform's success. The more people trade, the more revenue gets shared with the stakers. Simple as that.
And that brings us right back to the beginning. We've seen the high-risk, high-reward life of the trader. We've seen the slow, steady, statistical game of the house. And we've seen the ownership model of the staker. So it all really boils down to this one question. In this arena, knowing everything you know now, which role would you choose to play? Would you be the trader, or would you be the house?